Hello and welcome to Switzer. Okay, before we get started on tonight's episode, make sure you click the big red subscribe button and the bell notification next to it now. Every Monday we'll keep you up to date with what's happening on the market, the economy and more. And tomorrow night we premiere our Switzer property show. We have the man who tipped a 40% fall in house prices, Martin North, as one of our first guests. We have Charles Tarvey, the founder of Century 21 as well, and a whole lot more. And now here's tonight's show, and we look for stocks that stand out as buys following reporting season and what stocks you would play if a trade deal happens. CMC's Michael McCarthy and Berman Invest Julia Lee will share their latest market tips. And then Paul Rickard and myself will look at retail stocks following a discussion we had with Jerry Harvey of Harvey Norman earlier today. And then I'll discuss a new book by Simon Reynolds, the ad guru, called Win Fast. So without any further ado, let's go to Michael McCarthy and Julia Lee. Welcome guys, good to see you.
Thanks, Peter.
All right, so let's just talk about your attitude towards investing right now. Julia, are you keen to buy or are you sitting on your hands?
Look, I think the market, the normal fears are still there. It's the first day of spring and, we've seen a raising of tariffs both from the US and China. So from the US side, 15% tariffs on $125 billion worth of Chinese goods, including sneakers, headphones, Bluetooth headphones, speakers. And on the Chinese side, a 5% levy on US crude. So that's still rumbling around in the background and that remains a key risk to the markets. But I think the bigger risks for markets is that the yield curve is still signaling recession, and this week is going to be a big week in terms of data, whether we get, the manufacturing numbers from all over the globe, the GDP numbers here in Australia on Wednesday, as well as an RBA meeting. So all of that bubbling away. And one area that has been doing really well is gold, given that, we are seeing negative yields in a lot of the globe at the moment. Yeah,
Mike, are you worried about the bond market and yield curves?
What do those bond traders know, Peter?
Yeah. I've heard a lot of stockbrokers and people like that saying the same thing.
Inversion of the curve is a symptom, not a cause, Peter. So the fact that it's inverted doesn't tell us anything really. It does lay out what we already know. There are real concerns about growth and central banks are as accommodative as they've ever been in history. So we already knew that. The bond market isn't telling us anything new. There are real risks at the moment and a lot of events this week, as Julia's pointed out, that could see things turn around. But it comes at an interesting time for the Australian share market. Here we are back at 6,600. We had a melt up over the previous six sessions, Peter. That took us from 6,400 to 6,600 in a very short time. Now, if we do break through that 6,600, that means on the balance of probabilities, we're going to get a test of the all-time high. So I find it really hard at the moment to balance out the negativity that I'm seeing in headlines, that I'm reading on websites, that I'm hearing from investors with the actual market performance. So still doubting the extremes.
But people look at the index and think the index is a reflection of the overall attitude to all the stocks in the market. But there are certain stocks that are really in favour. So which ones are really grabbing the attention and driving the index up?
So to me, I think it's a really interesting time because I'm seeing a real difference in my portfolio where on one side it's quite defensive, looking at the volatility in terms of the market, and then on the other side it is still very much growth focused. I have to admit that August was a bad month for the market. It was down 2.2% and I was 50% in cash, but I've now moved to 25% cash, so a lot more positive, but there are still a lot of gold miners in terms of the portfolio. When I say lots, 2 or 3, but usually you don't see any.
What percentage of your portfolio would be gold?
It would be around about 25% at the moment, which is relatively high for me.
This is not your normal human being, let alone normal woman.
But when you think about it, the last few years there's been a cost to carrying gold, and that has been that you could get a yield. But with many places around the globe now with a negative yield, you're actually getting paid sometimes for lending out your gold. So it's a very different scenario that we're finding ourselves to the last few years. And I think that's something that investors do have to adapt to. The conditions that we are seeing globally, the conditions that we are seeing in terms of the bond market. And the fact is that the areas that have run are looking really expensive, whether it's equities or whether it's bonds, both have run hard this year.
Well, we have a service called Market Timing, which Percy Allen creates for us. And what I found interesting for the last 3 or 4 months since he's been doing it for us was his two signals were buy gold and buy STM. So buy the Australian stock market and buy gold. And then he's been absolutely on the money. He's got it right. Are you surprised, Mike, that markets are going up, but people are buying gold because they're afraid of the future?
Well, the performing sectors have been those very defensive ones. It's been focused very much on the bond proxies. It's been focused on those stocks that earn their money here in Australia and are less exposed to the trade concerns. Property's done well. Utilities have done well. And that kind of
expensive defensive we've seen, haven't we?
Yes,
well,
that's
look,
right.
I'd argue defensiveness is a function of price as much as anything else, and they no longer look defensive to me.
No.
But there's no denying the momentum in those sectors. They came off today, but there's still very strong momentum in them. So that tells me investors are very nervous still.
Okay, but if Donald Trump cracks a trade deal, how much can this market go up? Jeremy Siegel says anywhere between 10 and 20%. What do you guys think?
I think around about 10%. That sounds good. And I think the bigger issue for markets to get over is this possibility of recession. And if we do start to see better numbers due to the trade war, then that will help alleviate some of the market's concerns. But at the moment, the market is signalling that we need more rate cuts. And that's why these central bank meetings are going to be so important. The RBA this week, the non-farm payroll numbers on Friday, because that will feed directly into expectations around US interest rates.
Here's today's surprise, Peter. Today we saw PMIs, manufacturing activity indicators, from AIG and from CBA. Both of them moved higher. Both of them are clearly in expansion territory.
Yeah.
That is not what I was expecting to see today.
I love this. One of my favourite commentators in the entire world, who I've interviewed twice when I've gone to New York, Wall Street, is Art Cashin from UBS. And what he observed over the weekend was that he thinks Donald Trump's attitude is changing. He says, I don't know how long it will last for, but he said when the market dropped 700 points, he said, I think Donald might have said, was that me? And do you guys think he is actually getting a little bit worried that when he does play his big cards via tweets, banging China, that the market is becoming a little bit more spooked than to say over the last year or so?
Well, I think the market is getting spooked because we're starting to see the real implications of this US-China trade war.
As you explained earlier.
But the flip side of it is, we're going into an election year in 2020. November 2020, US elections. No president is going to want a recession just before that election because, it would be very hard to get a second term. So I think 2020 is going to be quite interesting and Donald Trump would be looking for a deal.
Yeah.
I saw an analyst put it another way today, Peter. He wrote, the market hasn't fallen far enough to turn Trump around on trade. But if there was further damage done in the market, we know it's one of his key indicators. He's bragged very often about the impetus that he's put behind the market. And there's no doubt that the tax reforms played a big part in the rally that we saw in the US. So, yes, I think he does take responsibility. Well, he's publicly taken responsibility for the good performance. I think he knows he won't be able to escape if the markets do fall further on this trade dispute.
And, he sees himself as a negotiator, but I think from a negotiation point of view, unfortunately, he's gone from being a price maker to a price taker. He's in a much more vulnerable situation in 2020, trying to negotiate a deal out with China because of the looming elections.
Okay. Enough of this highbrow intellectual market analysis. Enough of that. These people want to know what stocks you like. So, Juliet, reporting season's over. There's been another week of reports since we last talked. Last time you liked JB Hi-Fi.
Yes.
What else do you like now?
I like Nanosonics. I still like Eclipse.
Explain for normal people what Nanosonics does.
So Nanosonics...
Shrink stuff, doesn't it?
It's not the... it basically cleans ultrasound probes so that you don't get diseases from them. It's a box, you put it in and it cleans it. It has a Trophon 2, which it's selling, and it's really about the US expansion story at the moment.
There's still a good buy. There's plenty of upside. We want to know.
For me, the key in reporting season is to identify these strong underlying business trends.
Yep.
So when Trophon 2 is doing very well in terms of that expansion, you'd expect it to continue for a while. So I like looking at stocks like that and looking at those strong underlying trends. I guess on the flip side, one stock which had very bad trends was Blackmore. So they're the type of stocks that I like to avoid, even though they might show deep value. I like to see that strong underlying business trend first.
Mike?
Peter, high growth stocks. A lot of them have been battered largely due to poor reports, and I acknowledge that. But the time to buy high growth stocks is when they're taking a battering, not when they're riding at all-time highs. So there's a number on my radar after reporting season. I was really surprised with the market reaction to A2 milk. And that sort of pullback to me looks like an opportunity. Nearmap is another one. I really like their imaging business, imaging business. And while there are certainly concerns, competition coming in, a couple of changes to their accounting practices, I think that the pullback we've seen to 255 today is the opportunity. The other one I'm looking at very closely, and I'll declare myself, I am a shareholder here, and I've been hurt badly by Speedcast. But their satellite,
both of you have talked about Speedcast.
Their satellite data business, I think, has a real future, and they've got the jump in this business. It's almost a unique service. So at below $1, having traded above $7, if investors have any faith in their business model, this is the time to be running the world around.
All right. Now, what about WiseTech? It reported brilliantly. It's been good, and its PE is around 200. Can we buy a company like this on the basis that it's just a great company? Is it the next CSL for Australia, WiseTech?
Look, so I think we are seeing a bit of a revolution in terms of those tech companies, but you also want to see a clear path to profit growth as well. WiseTech is one of those that I do like, but I think you just have to be cautious at where we are in terms of the cycle, because yes, there's a great business model there, but on the flip side, sentiment stems so much out of what's happening in terms of the NASDAQ over in the US. So look, I'd just be a little bit cautious and I'd be neutral. I'm still happy to hold it, probably not adding to positions at this stage.
I certainly agree with the hold call. I find it very hard to get involved in current share prices. This is a quality company, and I really like the business proposition. There are risks, of course, but I'm going to wait, Pete, because the market's fickle, and they'll do something, say something, or there'll be a general downdraft, and that's the time to be jumping into a stock like WiseTech, in my view.
Is there anything else you'd like to throw in that people out there would think, oh, gee, I'm glad I listened to these so-and-sos?
If you're looking at gold stocks, I still like Evolution. EVN's the stock code. Well, basically, they have mines here in Australia, but also they have a great track record that when you do see, more difficult times, that they make strong moves and strong acquisitions. So I think the track record speaks for itself.
And what about, Mike, do you have a coal company that you like, or is coal off you, like Whitehaven, or are they off you?
I do like the coal business. I've been looking at Adani in India, as a matter of fact, because I don't think it can get much worse for them. And they are a conglomerate with all sorts of interests, and they're pushing ahead in a difficult environment.
How easy is it for us to invest directly?
It's difficult. It's difficult. Being a global trading platform, we get opportunities that others don't. But look, I don't know about coal though, Peter, but what I would say is price action is primary evidence. And the strength of the market, despite all the concerns, tell me there's underlying strength. And I suspect the key driver here is that lower Australian dollar. And at 67.30 against the US, we're getting stimulation in the Australian economy we can't see yet. So for those investors who are tossing the coin as to whether or not to be into the market, I'd point out that price action is telling us something, and I suspect that the cause of the better than currently forecast outlook is that lower Aussie.
Okay, I'm going to pick up in a second, but does that mean that BHP and Rio could be a buy on lower dollar?
Right, at 35.50, they're looking a lot better. The BHP's looking a lot better than when it was over 40.
Okay, to finish off, you've always been talking about gold. Is there a new stock you like, or you want to reinforce the one you like?
I like Evolution. Evolution because of its track record. Its mines here in Australia, and it has a track record of making strong acquisitions in a weak environment, and that's really what I like in terms of management. I think Jake Klein's doing a fantastic job there. So I guess Evolution in the gold space.
Evolution. Now, Mike, do you have any sort of mining stock or mining story that is valuable for people looking around for bargains?
I don't think you have to go past the majors here. Iron ore prices have tanked. They fell from above $120 a tonne to down to 80. In renminbi terms, that's from above 800 to below 600. That's a big corrective action in a market that is still being led by the demand, particularly out of China. So I suspect the big pullback we've seen in Rio and BHP's prices is a good time for long-term holders to be having another look at them.
Okay, Mike. And that was Michael McCarthy from CMC Markets and Julia Lee from Berman Investment. Coming up after the break, we'll be talking to Paul Rickard about our interview with Jerry Harvey. Are there any retail stocks worth buying? Is Harvey Norman a buy? Welcome back. We now want to shine the spotlight on retail. I'm going to do that with Paul Rickard. And earlier today, we interviewed Jerry Harvey for our podcast, The Switzer Show. And I thought I'd like to share it with you and also just have a chat to Paul about the things that Jerry said about retail and the economy and whatever. Paul, what did you think about Jerry's just overall tone?
Look, a little more downbeat than I expected, Peter. I thought normally Jerry's a pretty positive guy. And clearly, retailing is tough in Australia. He talks about that when we discuss his sales figures. But it was just the tone was fairly upbeat about offshore, a little downbeat, I felt, about the local market.
Exactly. I think his OS story was good. His his Oz story wasn't good. Let's just play a bit of what he said. How do you regard your report? It didn't look like you shot the lights out, but was it one that you're happy with?
Parts of it I was happy with, parts I'm unhappy with. I've just come back from overseas and I was in Ireland, so Ireland's wonderful now. We've had a turnaround there. All the big losses are a thing of the past. Slovenia and Croatia I thought were wonderful. They're a very small part of our business. But we will be opening more shops in Croatia. Malaysia I'm really happy with. Singapore I'm really happy with, but not as happy as Malaysia. New Zealand a bit disappointing and Australia a bit disappointing.
Okay, so how important is the growth of the Australian economy to the results that you produce each half year?
Well, they're the major part of our business and have been forever. So it's very important, but the other's growing and we have got a target to produce 50% of our profit overseas in the next few years. So at the moment, I don't know what it is, 23, 4, 5% or something. So that's fairly substantial compared with where it's been in the past. So if a quarter of your profits are coming from overseas, and that's a growth engine for you, then that's pretty significant, because if you look back in the last 200 years and how many Australian retailers have tried to make a go of it overseas, there aren't very many. There's a big incentive to really push that overseas because, we can see we're getting a very good result.
Okay, now let's have a look at what he said about his capital raising, because that was a significant part of the story when he reported. But as he made the point, he's done this quite a bit, hasn't he?
He has. I mean, there are two things that are a little unusual about the capital raising, Peter. First of all, it's a 1 for 17 issue, which is pretty small.
Yeah.
It's only raising about $170 million to pay down debt. I think that's important. And two, he's done it at quite a big discount. This is what Jerry goes on about, as you're about to hear. At $2.50 compared to a current share price of around about $4.50. That's unusual. And Jerry makes a sort of a position about it, and he's done that 2 or 3 times before.
Well, we know he's an unusual guy, and sometimes the market doesn't relate to what he thinks the normal person in the street would like. It's interesting. Should we see what he had to say?
Jerry, you also announced a small capital raising, I think a 1 for 17 entitlement issue at $2.50 to help pay down some debt. A couple of questions. That's a pretty small raising, and two, is that something we'd like to see your focus in terms of strengthening the balance sheet going forward?
Well, I've done that big discount to the share price on a number of occasions. Now, I mean, maybe that's the third. I'm not quite sure. I think it is. Certainly, we did it last time, but the share price wasn't $4.50 at the time. It was maybe $3.50 or something like that. But we did it at $2.50, and I thought, I wonder why other people don't do that. They nearly always do it with a price marginally below the share price at the time, and they mostly wait until their share price is at a high level, so that when Harvey Norman goes to $4.70, oh look, you can have some shares at $4.50, and then the share price drops to $4. So I've taken a view that if I give it at $2.50, a shareholder will be 4 or 5 cents better off straight away in terms of they got the share at a substantial discount. And then they get the dividend of 21 cents, which franks up to whatever it is, 27, 8, 9. So you're over 30 cents with the two offers. So that if you bought a Harvey Norman at $4.50 at the moment, you'd effectively be paying, say, under $4.20. So, you know, that makes it very appealing, I would have thought, because, you know, you're buying at $4, less than $4.20 when you pay $4.50. So I thought the shares would go up in price. Instead of that, they went down.
Okay. Now, he also brought up the word recession, which is kind of ties in with your view that he wasn't as bullish as he usually is. Were you surprised that he would actually use the word recession?
Look, Peter, you've interviewed him many times more than I have, and look, you're probably better able to comment about the R word.
Yeah.
But he was downbeat. He discussed his sales, and of course, Harvey Norman sales went backwards. This is the local franchisees went backwards in 2018-19. A little bit of improvement in the first 6 weeks of this year, so that's a positive.
Yeah.
But I would have thought he would have been said, look, take these 6 weeks, here we go, it's all turning around again, without sort of obviously spruiking the stock. But he still suggested that I think it's tough in retail.
Yeah.
And this is where the R word came in. I wanted to ask about whether there was perhaps a lot more disruption risk in sense that people were buying online and the Amazon and those type of other forces were impacting Harvey Norman. But he seemed just a little more downbeat than I was expecting.
And by the way, I've asked that question before. He says it's just so small, it doesn't matter. But I got to say, he sounded more like a responsible chairman of a publicly listed company.
Well, I mean, the market's been giving him a pretty hard time about governance. And if you look at the analyst reports, that's still one of their major concerns about Harvey Norman. And one of the reasons it still trades cheaply, Peter, it is pretty cheap compared to both the market and its competitors, is concerns about the governance and around, minority shareholders. That's the that's the 2/3 that takes away the Jerry Harvey and family ownership. How are they treated? And the market's still got concerns about
Next
governance.
time we talk to him, we'll bring up governance, but he will rip into us if we get too much like the AFR or the Australian when it comes to analysing governance in his company. Let's go to the final piece where I asked him about his comparison to JB Hi-Fi, and I actually had the rude suggestion that they reported better than him. Part of the reason for this capital raising, and you surprised me because I hang on every word you say after reporting season, and you mentioned the recession word pretty freely.
No.
And look, it sounds like you're predicting a recession. You're not predicting a recession, are you?
No, because David Jones did that. They beat me to the punch. And then people came out and asked me if there was a recession, the media. And I said, look, I don't think there's a recession at all. I said, so from my point of view, businesses, it's difficult. We're battling to get last year's figures. We've got unemployment at very low figures. Interest rates are very low. There's no way you could say Australia's in a recession. So if I said that, I'd be mad. And David Jones are mad for saying it.
Yeah, and a very brave suggestion, Peter, to actually suggest that. And I thought he might get a bit more aggressive with you. He didn't, as it turned out. Look, JB Hi-Fi did report better than Harvey Norman.
On a local basis.
On a local basis. So sales are up in 2018-19 compared to Harvey Norman's sales were down, right? Comparable store sales in JB Hi-Fi, that's the Australian electronics business, has started a little better than Harvey Norman. Harvey Norman points to that, JB Hi-Fi also has the good guys that have bought a couple of years ago. Sales were pretty flat there for the year and have actually started down. So maybe there's a bit of, we're doing better in sort of furniture and home furniture and appliances and white goods than JB Hi-Fi is doing. JB Hi-Fi certainly the electronics, computers and all that type of thing is, I still think, really smashing Harvey Norman. And I still think, Peter, are the best retailer in Australia.
Yeah, and they've got the cool and groovy younger purchasers, JB Hi-Fi. I think that really gives them a competitive
We're just
advantage.
going to the store, you see so many people, it's all sort of pretty effectively used. Harvey Norman always strikes me as being the traditional sort of home furnishings type place where there's a lot of space.
Where old so-and-sos like us should go.
Yeah, and you can lie on the bed or something. You couldn't do that at a Harvey Norman, at a JB Hi-Fi. And I think their turnover per square foot, whatever the metric is, probably proves that. So
okay, so that's we'll play Jerry's reaction to JB Hi-Fi. in a moment. Paul, Harvey Norman, is it a buy or a sell or a hold?
Look, it's got a very attractive dividend yield of 7.5%.
Yeah.
As a colleague of mine pointed out, when he bought it around about $3, it was yielding over 10% at the time.
Yeah.
The dividend, I think, is still under pressure. It's all the earnings are going in to pay that dividend out. I'm sure Jerry won't want to cut the dividend next year, but the market thinks he will. So, look, I think Harvey Norman, look, back around $4 is probably a buy. I think they've both, Harvey Norman and JB Hi-Fi, have had good runs. This stock was down at $3. JB Hi-Fi was down at $22 when the short sellers were in control.
And then when I've interviewed him, it's been around $3, and he's always told people to buy. In a sense, he hasn't given them a bum steer, has he?
He hasn't. Look, if I had to pick between the two, I'd probably still prefer JB Hi-Fi. But look, Harvey Norman lower down. I think you look, you can mark that down. The yield is pretty attractive.
Even if it dropped to 5%, it still would be a good yield. All right, that's the Harvey Norman story. I just did a quick look at other retailers before we end up. Well, Jerry, look, JB Hi-Fi looked like it reported better than you, but I'm sure you can set me straight. So, did they report better than you? And if they did, why? If they didn't, tell me why.
Well, you would have to go through the categories, and certainly in the categories JB Hi-Fi are in at the moment, a couple of those categories, they did outperform us. But then if you go into TV, white goods and all that sort of thing, and the good guys part of the JB Hi-Fi outfit, then at the moment, I think they outperformed us till the end of June, but since then we've outperformed them. But again, it's so marginal. And then when we check our market share figures over the last year or two, the truth is that JB Hi-Fi, the good guys, and Harvey Norman own most of the market. And there's none of the three, their market shares are not changing to any extent.
Kathmandu, FN Arena says it could rise by 1%. Super Retail Group up 3.2%.
And they reported well, Super Retail
Do you like
Group.
them?
Look, I do. The yield's reasonably attractive. There's some concerns around the BCF business. That's the boating, camping, fishing business. I think they've been driven very much by the autos. Super Cheap Autos is the main auto business. That's sort of held it up. They're apparently doing work to rejuvenate or rechange the mix in BCF. But look, I quite like them. I maybe again a weakness type stock.
Okay, finally, Bapcor, and this is a company that owns products like Autobahn, but they also do a lot of supplying to the mechanic industry as well.
They actually do more supplying than they do retailing. So about 2/3 of their revenue is so-called business-to-business revenue. That's actually providing facilities and equipment to spare parts to motor repair workshops and dealers. In other words, selling to trade, not selling to the general public. They're obviously their Autobahn's their major retail brand that we're probably all familiar with. Yep. I do like the business, Bapcor. I think it's reasonable. Yeah. It's pretty solid, and look, they've come under attack as have a lot of the auto service companies around the so-called rise of electric vehicles, and how that's going to kill the mechanical business. But as they point out, the electric vehicles, even in some of the numbers on 2030, will just be still a tiny fraction of the fleet. So I think they got discounted for that. The market sort of, a bit like the market knocked all the retailers off because of the so-called Amazon threat and just killed them because Amazon was coming to Australia. It's a long-term factor, right? Electric vehicles are a long-term factor, but I think that they look all right. So at the right price, I quite like Bapcor.
So Bapcor, BAPCOR. The analyst thinks it's got 7% upside. I think you're right, Paul. Bapcor is a good company. Thanks for joining us. Achieve more, earn more, and be more with this practical, real-world guide for people who want to become great and are not ashamed to admit it. This is a book written by a guy who effectively has become great. His name is Simon Reynolds. He was a guru of advertising in Australia, went to America and has become an executive business coach. He's on the speaking circuit, a high achiever, and is someone who could write a book called Win Fast. I'm now talking to Simon Reynolds. Thanks for joining us, mate.
Oh, it's great to be here.
Yeah. So, Simon, I guess I should, for people who don't know you, and younger generations might not know, because when, 20 years ago you were everywhere, because your most famous production, of course, was the HIV/AIDS commercial. Tell us about that.
Well, yeah, I started in advertising when I was 18, and so I didn't go to university, much to my mother's horror. And when I was 21, I wrote that ad, and that really...
it was a Grim Reaper commercial it became known as, didn't it?
Yeah, and that was huge. And it allowed me to open an agency at 23, and then we opened up in New York at 26. And then probably 20 years of growing agencies and selling them, and sold one to Singo. So quite a long path there. And then about a decade ago, I had the opportunity to move overseas with my wife, and since then I've been executive coaching and speaking on leadership and productivity.
Okay. Why have you written a book like Win Fast? Who are the people who you think are going to benefit from all the stuff that you learned along the way? And there's two streams I think that you offer value. You probably think there's more, and maybe I'm being unfair.
I'll take two. That's good. That's
well,
good.
one is that you've grown a business from scratch, so you know what it's like to be small, and you know what is needed to get to a big size. But you've also been an expert on brand, and one of your companies was called Love, wasn't it?
Absolutely.
And because you always believe a brand needs to be loved, right?
100%.
So the people who you're talking to, are they the sort of people who will benefit from those important streams where I think you've got enormous strength?
Yeah, look, I think the heart of the audience for Win Fast is people who are ambitious, but they're somewhat frustrated because they've got so much to do, so little time to do it in, and they feel overwhelmed. Still ambitious, but overwhelmed. So it's really about how do you get things done faster? What are hacks to proceed along your career path or along the business path and do things fast without taking 20 years to do it?
A lot of people find that they create a very good business that a small group of people really love, but they don't know how to ramp up that brand to get a much bigger audience. What is it that you think that holds them back? I often say to them when people ask me, you might have to invest in success, and you might have to pay for someone who can see what you currently aren't seeing. Or is there another answer to a person like that?
Well, I think that's very true, and I think part of the problem is a lot of business owners don't respect brand. They think, oh, okay, we've got to get sales in immediately, and brand has nothing to do with sales. But you've probably got the preeminent individual's brand in your whole field in our country. So I know you'll agree with me that it's a slower process to grow a brand. But step one is to actually believe in it and start doing it. Step two is to learn about what it takes to grow a brand. And that's like any other field, it has elements that you've got to master. And I think too many business owners and too many CEOs are not spending the time to invest mentally, but also financially in a brand.
Now, correct me if I'm wrong. I don't think I am. But at one stage when Apple was struggling in this country, you were responsible to try and help them out of their funk. Was that a pretty true story?
That's 100% right, yeah.
So did you deal with Steve Jobs at that particular point in time, or people who represented him?
You know what, it was all his representatives, but I had a funny time once when Steve Jobs left and went to Next, but Next was just a tiny building. I happened to drive past it in Silicon Valley, and I stopped the car with a couple of mates from work, and I walked into reception and I said, I've come all the way from Australia just to spend 1 minute with Steve Jobs. And they totally refused me. But Next was, his new company was so small, undoubtedly he could have heard me from the stairs.
Oh, really?
Yeah. So I got within 30 feet of Steve Jobs.
Okay, right, yeah. But that was a brand that was really struggling at that point in time. So you would have thought through what they did to elevate the brand. And I guess it's possible that the brand was okay, but the products were bad, or was it a dual problem. Products were bad and the brand was bad at that point in time.
Yeah, it's a great question. And brands are all about simplification. So the two issues that Apple had at the time was corporates didn't believe in it.
Yes.
It was all about buying an IBM computer, which seems like a lifetime ago.
Yeah.
But second of all, consumers thought computers were too complex. And so the two strands of the Apple brand, how we rebuilt it was it works for corporations, and that took a long time to do to get them to believe that. But second of all, this is a computer that's simple enough, as the line was, simple enough even an adult can do it.
Yeah, very good point. Very good point. All right, so going back to the smaller businesses, if a small business person read this book, do you think that they would change the way they do their business?
Oh, unequivocally. And the reason is it's full of all my challenges when I was growing my businesses from scratch and how I address them. So for instance, how do you use your time? You know, I have we've all heard of the 80-20 rule, that 20% of what you do gives you 80% of your results. Well, what about the 20% of the 20% most important? What I call a 64-4 rule. 4% of what we do gives you 64% of your results. And that's very important for a small business operator or even a large business operator. You've got to sit there and resist just doing your emails, resist just doing meetings, and say, what is the handful of things that I can do that will actually make the difference rather than just getting busy?
Yeah, it is funny. I know that there was a time when a part of our business just needed a door to be opened, and all the people below me couldn't open that door. And the CEO of that public company I met in the airport, and I didn't know him, but I figured he might know me. So I went across, shook his hand, told him what we're doing, and he said, get your person to email me on the weekend. Now, that was what my strength was, that I could talk to someone like that. And I then reflected, maybe I should be doing that all the time, targeting the people that most people can't get to because maybe I can get to. So you're saying that a lot of businesses have those kinds of 4%ers that are worth, did you say 64% of your results?
Absolutely. And the one you mentioned is a classic one, an endemic problem, in that most businesses are not asking enough for money. They're not asking for business. They're not getting on the phone and calling or having a consistent email campaign or even having a consistent advertising campaign that consistently brings in leads. And because they don't reach out enough for customers, whether in person or through technology, they shouldn't be surprised that they're not growing. And it stuns me how many businesses, big and small, have the problem of not actually having sophisticated systems to bring in leads. And that could be a person that you meet, or it could be 10,000 people you talk to.
Okay, so you've talked about better business approaches and systems to get the best results. What about changing the personality? How important is it for someone who wants to grow a business to change the attitude? You know, they were saying your attitude determines your altitude. Is that something you address in the book?
Oh, immensely important. And so many business operators believe that they've reached a ceiling for their business. Oh, we can't grow, the business has got bad economics or whatever. And I always say, is there a business 10 times bigger than you in the world? And if the answer is yes, the problem is you as an individual. It's your attitude or the way you see things. And that's confronting for many people. And it's interesting, you know, you can spend 80 grand a year to do a Stanford degree in business, and they won't spend 1 hour talking to you about the inner self of business. But you as a highly successful business owner, and me as a business owner, we know, as you know, success in business really is an inside job first.
I remember many years ago when I was interviewing you, and I think you were working with Singer at the time, and you said that what a lot of people in small business don't realise is that, and I asked you about what is advertising, and you said everything someone does in a business effectively is advertising, from the way they answer the phone to the way they talk to their staff. Is this something that you still believe in? Because it was a great point of view, and I think I've learnt from that.
Yeah.
Is that something that you found has been a continual given in the businesses that are successful?
Oh, unequivocally. And what I see all the time is businesses that have no advertising but do really well. Why? Because of all those touch points. When someone deals with customer service, they feel good. When someone walks into the store or the company, they feel safe, or they feel it's appropriate. When they see a brochure, it reflects brand values. All these little things that aren't technically ads, but are ads. Because advertising and branding, it's really just a perception in the mind, and our perception is affected by things big and small.
One last one. How important is happiness in a business?
Well, look, it's really behind all the near-term goals of money, it's really behind a lot of how anybody ends up in business, isn't it? Or even how they select a job. And it amazes me that people aren't spending enough time on asking themselves, what would make me happy at work? Or how could I enjoy my work more? You know, so many people are prepared to do 20 years of hard labour when they could have enjoyed the process along the way.
Yeah, exactly right. So I presume it's available in all good and bad bookshops, online and all that sort of stuff.
Online, offline, everywhere.
Okay, mate, great to see you.
And you. Cheers.
Simon Reynolds. The book is Win Fast, and given my knowledge of Simon, when you read this, you will change and you will be successful.